and get going. Okay, so again, we're going to be talking about the trigger charts. Trigger charts. Got a lot of triggers going on here. We're talking about the TriggerCharts Radar indicator, and what we're really going to talk about, some of the goals here of this particular webinar, which will last about 30 minutes. We'll make it quick, and there'll be a replay of this available on the TriggerCharts website. But we want to really kind of get into the whole idea of what's a smart indicator, because one of the things that you know is that there are a lot of indicators out there. There's a lot of people who said that, hey, put this on your chart, and, you know, hey, great stuff. There's even easier things, people simply just doing a, giving you lists of things. Lots of places where you can get lists of all sorts of different things above, below the moving average, or, you know, those that are not only breaking above their 50-day, but above their 200-day, and crosses and all sorts of things. But what we really want to find out is something that we can rely on, number one. And number two, I think more importantly, is that we want to find some that have a little bit of vision into the future. Now, obviously, there are different ways to look at this. There's all sorts of neural types of networks that you can set up for looking at historical data and then going way out and trying to predict what's going to happen. We're not really looking at predictions here. We're really looking at the levels that we find are key levels that are built upon not only price and time, but volume. And the important thing there is that when we look at a place that we can find volume support, not just simply looking at a chart vertically or horizontally and finding where that is, but if we can really find out where that is, we can see where the institutions are really bulking up, holding the position strong, or in fact, where they're letting things go. And that's where you get this wonderful opportunity to find initiation points. Now, we'll go quickly on some of this. Basically, what we don't want to do, like we want to do in all of these indicators that we have. We talked about the altimeter. We're having the altimeter come up. We talked about the total commander series, and I'll give you some more information of that, where the next one's going to be. But basically, we want to eliminate one side of the trade. In other words, when should I be long? When should I be short? When should I not do anything? Where is the initiation points? Where's my level of risk? Where am I going to actually take a bailout of this in terms of stops or profits? Very important. That's some of the hardest things that you can find, but also finding more than just support and resistance, but you want to find where the breakouts are going to be, because you can really just draw lines and find support and resistance, but we're really talking about at what depth, at what level are we going to find that if they break, we're going to see some significant velocity of movement. That's what we're really looking for there. Okay, and we want to be able to find these visually, look at what's happening, because maybe you have, 10 or 15 different positions you're looking at, or maybe an entire list, but how can you easily find where those points are and what's going to be looking good, as a matter of fact? So what we have is this whole idea of a market that's balanced or imbalanced. We'll find out where the level is at this point. So let's think about where a market is in balance, or not imbalance, but in balance or balanced. What you think of there is when you're finding consolidation. This price agreement at these approximate levels, whether it's between a range that's a little bit wide or a little bit narrow, but there's some price agreement overall, and you'll see a chop between there, or it may even seem smooth at the time. Where you find an imbalance is where there's a lack of any kind of interest, participation, and those are the areas that have limited participation and volume, and therefore you'll either see a significant rise through or a drop below. Think about when you have a stock that has been, kind of moving around in a general direction between a couple of percent up, a couple of percent down, and all of a sudden it just blasts off. Well, why is that? Well, probably because one of the big reasons is that there was a significant amount of price agreement at a certain level, and then all bets were off. It just blew through there once it got higher than a certain level. This is very important, and I want to highlight this because I think this is very, very important to take a look at. Fast zones versus slow zones. Fast zones versus slow zones. A slow zone is, kind of a range that we're finding that a stock will move between and just move around, maybe break above, maybe break below. Okay, great. Now, a fast zone, for example, will be totally different. A fast zone will be, for example, where you have a stock and boom, or it's moving along, consolidating, and then you get this move. Now, one of the things that you see different here than you did in the consolidation area is you're getting a fast vertical move. Sometimes you hear the word parabolic move, or other ways of describing where you have a vertical move that's very quick through time. So what's happening is you're condensing the amount of move within a time period. And that being the case, that's what we want to look for, right? Wouldn't you rather have that kind of a situation where you're seeing a fast move through time versus a consolidation over time, especially if you're trading, of course. So we want to also find where there's going to be a breaking opportunity on the upside or downside, or whether it's consolidating. And we can find that for any security or a market. Any of the above that we think about can be either, whether it's a currency, whether it's a future, whether it's a stock, ETF, it doesn't matter. Now, when you look at this, and I'll wait for this to load, I want to show you something here. This is the same chart, but what we're finding is there's two different views. Now, the top view, what we see is a traditional chart, and what you see there is an area of movement of the stock up and down and breaking around, and it's actually vacillating in price. We have time, of course, across the bottom, and then we have volume, and volume is based on a daily move. Okay, so this is a daily Microsoft chart. And what we're finding is that this is actually giving us the volume at the end of the day. Now, what we can see right here in the area where we saw that dramatic spike, right? So right here, these two right here, the big spike of volume, was that Microsoft dropped off very significantly. Maybe it was an earnings announcement. Maybe it was some other product issue. It could have been 100 things. Bottom line is there was a big drop off. And we see a one-dimensional view of this. Now, on the other hand, wouldn't it be nice if we could really see throughout the entire time that if we pick a point, we say, okay, there was really no volume here and no volume here, because what happened was that clearly Microsoft gapped lower. But in between this entire range, we don't know how much of this volume was actually moving at what level. Maybe there's a lot of volume at the lower point. Maybe there's a lot of volume at the upper point. We don't really know that from a traditional volume look. All we know is that there was a lot of volume. Now, when we come down to the bottom chart and we take a look at that, what we see is, even though this is a little bit difficult to look at because it's covered up, but again, there's a lot of settings you could do here. But we're trying to show you that what you see here is that you had a very defined consolidation that was going on for some time. Then where you see, and I'll explain this in a second, what these blues mean and yellows and reds, what we see is that there was a breakout that was pretty substantial. And then again, another very thick range of color here that was showing a consolidation. But inside of this, which is a 30-day period, let's say, what you saw was it's maybe a little bit longer than 30 days here, but what you're seeing here is that there's no volume at the 34.5 down to about 33, not a big range, 32.5 to 32. So what you're finding is another consolidation point. And you can see that in the top here. It's showing some consolidation, a little bit of a breakout. But again, even at the top, you could find right here, there was no volume. You look left. Look left. There's no volume that really accumulated at those prices. So what we're doing really here, if you think about it, is we are turning volume on its side. We're finding where the key levels of interest have been throughout the range. Now, whether you have a 30-day range, a 7-day range, or a 60-minute bar, or whatever you have on your chart, this all works perfectly. And if you could find where there's very limited activity and interest, and when the color is changed to a purple or a blue, it's very, very cold. When it's red, it's very hot. And a yellow line through all of it means that you're going to find a very high level of volume at those areas. That's the area that during that entire range you found the most agreement in overall price. So those are not the times you really want to invest, although those are the times you may want to do a contra trade. You want to say, okay, if it bounces off of this level, we'll take a look at the downside, and if it comes down, or if it bounces from the top to that level, we'll look at a bounce on the upside. You want to break out. We really want to find where we're going to move from this slow range to a fast range, because markets move like that. You know that. Doesn't matter what market you're looking at, but there is a slow range, a slow time, and a consolidation that always follows something. And it's going to be followed by a fast zone. That's the nature of markets. Consolidates, price agreement, and then maybe there's not a lot of activity, maybe volume comes down, and then when the next move happens, whenever that is, whether it's a stock or it's going to be a market, that is when you find that there's going to be those major breakouts, and those are the times you really want to be involved in it. But again, it's all about market balance and price levels that are conflicting between buyers and the sentiment, or if there's no equilibrium at all. And what you get is a nice color chart. We don't even look at the volume on the bottom anymore, and you can find out where the actual accumulation is, or where there's no accumulation of the of interest at that level. So we talked about this whole idea of fast zones, and we talked about the idea of slow zones. But take a look at this, because this opens it up a little bit more, and this is really, I think, very important to look at. Focus in on this chart, and this is the radar. This is simply the radar on here with a very simple candle chart, which shows the days on the upside of green and the red, which is the down days. But what we did was we took volume again and we flipped it. But not only flipped it, we're giving you the intra-bar calculation of where the volume is here. That's why this is so important, and why this is so good. You can see that again in this particular chart of Questcore on a daily basis, that there was a very big gap. We went basically on a couple of different occasions. There was a gap. You could see this if you didn't have this on, the radar was not on the chart. But you see that there's a gap, no volume. There's another gap, no volume. See how the no volume areas show that there's very little area, again, depending on how long you put the settings for the radar. If you put the settings for the radar on, let's say 1 day right here where there's a gap, there's going to be no volume there. It's going to be a big empty area. At the same time, this entire range that we're looking at here, all the way from, let's say, September back through, let's say, June, there was hardly any volume in the area, about 65 to about, we'll call it 50 right here. Now, isn't it interesting that once you broke below any of the supporting levels that is definitely marked in a yellow because there's high levels of interest there, you saw this quick move down from about, we'll call it 65 to 55. That's a pretty good move right there. And where's the potential downside? Well, in this chart, you can simply look at it just at this level and say, well, if you want to really pick up where the potential for a level of support and resistance, you would have to say something like around the $50 level is your support level here, if it did in fact continue on its way down. And you'd have to say that the resistance is about 65. And again, you can get those simply by looking at the yellow lines. It's a little bit more than that, but we tried to pick a chart that was very easy to pick out the zones and the ranges. So again, you have these high density red areas, which is very hot, which is very much participated in by the markets and by investors. And you have the blue areas and the purple, which starts it, but the blue areas on the spectrum, that's very cold. And inside of that, if you see something like this, and it's over the entire range, there's been no participation at all in that area, the potential for a drop down, especially if you get into the very, very thin areas of volume, is very high. Or again, it goes either way. You can either look at it breaking up or breaking down or consolidating within. And basically what we're also looking at here is the whole idea of where is the supply and demand, because every market really is dealing with supply and demand. And again, here is a closer look at the zones that are considered very, very cold or blue, and these are the fast zones where things move very quickly. Look at the differential on where it was consolidating along the top where we see the consolidation area, and you get a lot of volume build up to how the stock moved. You move from 65 to 70 and back down. But look at this drastic move within this empty area. Again, it's moving fast through time, more vertical than horizontal. The trade is always going to be more of a vertical is what you want to look for. So let's take a look at a couple of different charts that are out there that maybe we could take a look at. And I picked up a couple of extreme examples that would be something that we can look at here. Let's wait for this to come up. And here's a daily of Apple. Now again, we can use any particular chart that we want. This works on any time frame. It's very easy. You can see I'll just switch around and pick up a 60-minute chart here, which will come up on your screen. And you can see the same thing. And all of these have settings. You could take as many of these individual components, whether it's going to be the level of, let me get a tool here. So you can take a look at here that this particular radar, which encompasses the entire range from 9/18 through today, and you can see what the range was. And again, you can set that up to be a 30 bar, or 15 bar. We have some suggested settings that we can give you. But basically what I want to show you here is you can find where these zones are. Now we know that if we look back, we can find that there's very little participation, obviously, because of this significant amount of movement during this period back on 9/6 through 9/11. Now, if in fact you look back, and let me I'll give you a line of this. If you look back, I would say that if you break down below the 482 level, that the opportunity to move much lower down to 475 is very easy. That's a 60-minute chart, and you have to realize it's 60-minute. You always have to remember something else, that the longer-term charts take precedence. So you want to take a look at this, but then you also want to go and, let's say, look at the daily chart. So in the daily chart, we're seeing that the same situation has occurred, that there is a range of approximately, let's call it between 467 all the way up to about 493, and probably somewhere inside of here, that is a little bit more actively looked at as a potential area where you're going to see volatility. Now, I want to show you something. Look at the difference of a consolidation zone in this area between about 505 and 492 on a daily basis. Look at the individual positions, the daily bars, if you will, and see how they're kind of tightly organized and all. But look at this. All of a sudden you're getting this big gapping, ugly moves, whether it's, up or down, and it changes complexion dramatically. Now, if you were to go back in this chart and look, you can see again that where you have these vertical moves back over in April, you have these big vertical moves. That's where you're going to have the least amount of support in between. And if you can consolidate this and look all the way backwards, if you can train your eyes to do so, you can see that approximately about 441 is probably one of the zones that would be a really good support point for Apple. And then we can go further and look at the weekly and then say, okay, well, where's that 440? Does that make any sense? Well, look at that. It just happens to be that approximately 438 to 440 is right on the bottom, and where people would consider this to be a pretty good support level if they were looking. But if you also look back, one more further point is that look at this whole range back in the beginning of the year. There is no support at all, and the only thing we really have is now a resistance point at about 517 down to a support level of about 434, and below that, there's nothing all the way down to 381. So when you look at these, you can combine all these potential the potential overall levels to see, okay, hey, we have a weekly that's showing us where the downside is. Then we look at the daily and find out where the support and resistance is and where we're going to possibly initiate a trade. And then we look backwards and see what's happening on a daily basis. And you can go through this process very easily. Now, the radar is just one tool in the total toolkit, but it's something that I believe is very important to use because it gives you a kind of an x-ray of not only the markets, but it gives you of individual positions. Now, there's another stock, for example, I want to show you. This is an extreme circumstance. This is USU. This thing moves like crazy. I mean, from, how'd you like to get your hands on this? $4 up to $28 in a matter of days. Pretty substantial move. And there's nothing really that would have warned you or told you anything about this. It was probably news-driven. But one of the things you can see here is that historically, moving back, and let me kind of bring this even further back, you can see there was a consolidation that was involved here, and this consolidation was when you saw all the tightly knit radars that came along. Very clumpy, very tightly knit consolidation. So where would you look at for a breakout? Well, if you were to do something like this just from a chart now, we're just talking about a chart, not recommending the stock, etc. It's down 7.5% today when we look at this. You probably want to say, well, above this level, this thing could really take off. There's no consolidation or any kind of movement. You could even say that maybe above the $10.50 range. But now what's interesting to note is when you look at this now, again, hindsight is 20/20, but when you look at this now, you can see that there is a pretty good level of support here at up to about 950, and that goes back to the level that we saw back in May, and then again back in April, and back in March. And by using this to find out where these zones are, it's very easy to find that, if you did get to the level all the way up here and you were playing this, man, as fast as it came up, it had the opportunity to come down just as fast because there was really no support at all involved. Now, just to give you one more piece of information, I'll just turn this on for 1 second. If you look at the altimeter, let me kind of just show this to you for the heck of it. This is the other tool that gives an algorithmic level that we've calculated that will give you a condensed version of the radar. And you can see that the levels and where the takeoff points are really located in a very easy to understand fashion. And again, whether you're working on a chart that is based on 60 minutes or 240 or 30. We don't like to go into 30 minutes, by the way. I don't think that's really recommended. You want to be able to have these areas of accumulation and of volume participation build. It's very important so that you can make up these various ranges. Very important when you're talking about something called market profile, which is all based on. But again, what's really interesting about this is that you can see very defined levels of support and resistance that go through here. Now, when you take this and then add the radar to it, you can see that the ranges are very similar, and the high volume areas become support or resistance where there's a yellow, or where there is a blue area, etc. So these are all very important to look at. They work together very well. You can use one or the other as well, but right now we're really focusing on the radar, and the radar really is the bread and butter, in my opinion, of all of the internal movements of all. It's really looking down and getting into all this. One more I want to show you here, and we're going to look at Catamaran. Catamaran came out with some great earnings, and the stock made a really nice move. Let me bring you the daily for you to show you that. Made a really nice move. It went from about 52 to about 58, but you can see that there's very volatile, and I'll even condense this more for you. Actually, yeah, let's bring it right there so we see a full range here. Now, what you see here is, again, very volatile stock. It has some defined levels on the bottom. You could say that if you didn't see this, there could be a triple bottom coming up right about here. And what we are seeing is there is some decent participation moving back to this range, the one radar back, and then the secondary radar back over here. Back in May, what you're finding is that also at the same time, there is some nice support there. But at the same time, realize that look at this free fall. Now, this is what you call a vertical drop. That is not a consolidation. This range is consolidation. So his price agreement approximately at the 55, where the stock broke to initially on the gap up after earnings. And then it did a little bit of a further move, and it came back down, and there was price agreement. But once it started moving below the radar area that had any kind of volume participation, look what happened. And you can look back further. Say, well, there's a big gap over here. We know that because we saw the gap. We saw the gap. But look back further even more, and you say, well, there's volume participation, but it really, if you get past approximately the 54 range, you're going to get a gap down probably to about 53. And then there's not much going on, and you got this immediate move down. You see that it held actually over here. This is if you look at the bottoms of all the radars, it held on 918, and then just broke down. There's nothing really below here down to where we're finding it right now. So this gives you a nice look at where the use of this is, and you could find out really a lot more about what's happening with a stock or a market or a currency from looking at this. It really gives you a great view. Now, what you have is on the applications of this, basically you have these profiles that are set up, those ranges that we talked about, and again, it's revealing the tendency of the market, which way it's going to potentially move, but more importantly, all about what is the the total amount of volume participation in any price. And if you don't think that's important, you really do need to understand that that is what everybody's looking at in terms of the professionals. And then these are really useful on the longer time frames where you could find out where there has been a big amount of participation and where the buying really takes place and when there's really not. Because using the old version of volume, it's hidden. And by the way, everything is available on TriggerCharts.com. I'm going to send that through the chat to you. You don't have to go there right now, but all this is available right on TriggerCharts.com. You just look it up. And here's the radar. Here's a kind of a big look at it. And basically what we see is that each of the individual radars is a market profile dependent on the time frame that you put in, dependent on some of the settings that you put in. These are all configurable within radar. And of course, these are available only on TradeStation, which I'm going to tell you how in a minute to get these free. But again, look at the colors. We color-coded this so you know that the levels of support moving into the future are going to be in the areas of high accumulation, and those areas that don't have support are going to be colored or not colored. They're going to be, moving into the purple area or into the blue area or not have any coloration at all. And then also we want to look at the segmentation lines. We go between these green segmentation lines. The market is biased in vertical area, and we're looking at the previous values to become support or resistance. So these are the ranges and where there's a swing happening or where there's actually a vertical move potential going to happen within the radar. So you have now a green line that gives you a segmentation of the actual range, and you have red and orange, which is the high volume areas, and then you have the blue and purple, and in that whole spectrum, which starts to be low volume, low participation areas. So you could plot as many of these that you want moving backwards. As a matter of fact, you can put on multiple radars. You can put them on a chart. You can put on, for example, a radar that looks back 5 radars that are there that look back 7 days, and then another set that is 30 days, and see where they overlap. Really interesting to look at, and that's all, like I said, configurable inside of the inside of there. So now the other thing I'll mention, and we're going to try to keep this to about a half hour or so. You can actually get these for free. There's a program through TradeStation that really isn't well known, but you can go over and you can for new accounts only. And by the way, even if you have accounts at TradeStation, all you have to do is open up a new account and transfer some money in, and you could actually get through their program up to $3,000 that is paid for the indicators. Okay, they credit TriggerCharts indicators with that amount potential. So that's pretty good. You can get this totally paid for by TradeStation and through this rebate program. So if you want to find out more about that, you can, and it's pretty simple to get to. You just have to go over to TriggerCharts.com. I'll give you actually the actual URL here, but basically you go over there and check it out, and somebody will either contact you or will give you the ability to find out more about it and what it's all about. So let me give you I'll give you a hang on a second. Here we go. Let me give you the URL that's coming right now. You can store that as well. Okay. If you're interested, you could check that out. The other thing is that all these indicators that we have that we're talking about are available on a 10-day free trial through TradeStation. And if you give a review, whatever the review is, what if you give a review, a simple review on the TradeStation Strategy Network, we give you a full month free of the Commander Series, so you can use that. That's a nice value for you. And all you have to do is just give us a review if you've used it. Now, if you haven't used it, I really do encourage you to check it out. The 10-day free trial will give you a lot. We send you some information. We send you a full user guide, and there's a lot of the webinars and other educational materials that are behind here. But if you do understand the importance of the entire process here of market profile, it's really cool. Now, one of the things that's coming up, we're going to talk about Autopilot in our next webinar coming up, because this is now taking all of the information from Radar Altimeter and now putting it into an algorithm that basically gives you a color code of when to be short, long, out in the market. And you can see, for example, here's a 60-minute chart of gold, and you can see pretty much how well if you did hit that gold at 1690, covered it at 1668 all the way to the right, or if you were long, it told you when to take your profit, you went in about 1690, took $5 out of it. This is a 60-minute chart, so it's quick trading. But you can do it for daily or whatever else. Very easy to understand, where you have green is long and red is short, and then you have your entry alerts, which is yellow, orange is exit, and the magenta is stop. Again, all configurable on any position, whether it's futures or a stock, or if it is in fact a forex instrument. So pretty cool stuff. So we have a couple things coming up. We have the Autopilot coming up on 10/2. You can go register there. We'll send you some emails about registration for those. If you want to check it out right now and you want to, in fact, register, all the events can be found on the TriggerCharts site. Here's another link for you. And also tomorrow at 4:30 in the afternoon, we're actually doing a showcase with TradeStation, where they're going to be putting our products up. They don't do this that often, and they do it for every particular product. But they're going to be actually hosting a presentation that we're doing. And again, if you go to the events area, all that's available, how to get to it, and we're going to go through the entire Commander series tomorrow and go through some questions and answers, etc. And here's the rest of the things that we're going to be talking about. We have a key resistance reversal indicator. We keep on writing resistance as reversal indicator that's coming out. Pretty cool stuff. And that's going to be coming up as well shortly. So this will be, in fact, on the TriggerCharts website shortly. All of you that have been here today will give you the link so you can watch it again. I do move rather quickly, and I really do encourage you to try these, and nothing else, just test it to see where the levels are that could be breakouts, and then see what happens from there, because I think you'll be pretty surprised at how the accuracy of some of this. It doesn't always work out exactly as you want, because there's news that comes out, market issues come in the way, wars that break out, all the other stuff that goes on. But if you're especially doing some trading, not necessarily long-term investing, although it works for that too, trading gives you some really good points that you can look for initiation and looking for closing positions, etc. Anyway, thanks for joining me. Questions, you can just send us emails. We'll be happy to answer any questions you have, and we'll go from there. And hopefully see you on tomorrow at TradeStation, and when we have our next Autopilot discussion as well. Thanks a lot.